Chapter 12 in economics, oligopoly. When we talk about oligopoly, an oligopoly market is a market that is characterized by small numbers of firms that dominate the market. So the dominance is by few firms. Though there are large firms, there are more small firms, there are large numbers of smaller firms in that industry. But the ones that dominate that industry are few large ones. So the number of firms that dominate the market and can influence prices and market conditions. So this market is considered in perfect competition because firms are interdependent and their actions significantly impact on each other. So there's interdependence in an oligopolistic competition or oligopolistic market. Why? Because the few large firms there, whatever decisions they make, might have a great impact on the market itself. So that takes us to the assumptions of oligopoly. The first one I wrote is few sellers. So the supply in the industry must be concentrated in the hands of relatively few firms. However, it might contain much larger number of very small firms. So the largest number of supply comes through the few large firms there. So that means when we talk about oligopoly, we're talking about the concentration of supply within the few large firms. Though the other small firms are there, but when we talk about the large chunk of the supply, it comes from the few large ones. Two, interdependence. Firms in an oligopoly are highly interdependent, meaning that the actions of one firm, like price changes or marketing strategies, can significantly affect sales and profit of its rivals. So whatever decision one firm makes, it will affect others in an oligopolistic competition. Do you understand that? Yes, good. The next one, the third one is our product differentiation. And when we talk about product differentiation, we're talking about firms in an oligopolistic market trying to sell a product that is slightly different from those of its competitors. Example is in the car industry, the automobile industry. There are different cars, there are different brands. But when you look at the cars they make, there's always product differentiation in them. And product differentiation is simply a strategy that makes your consumers feel that your product is different from those of your competitors. So in an oligopolistic competition, it is likely it happens. Clear? So that takes us to the more important barriers to the important characteristics to an oligopolistic competition. So we're going to start with barriers to entry. So barriers to entry, when we talk about barriers to entry, we're simply talking about the hindrances that make setting up or closing down a firm becomes difficult. That is what barriers to entry is. Do you get it, please?
Yeah.
So what are the reasons why there are barriers to entry in an oligopolistic market? One, economies of scale. When we talk about economies of scale is a cost advantage firms have because they are expanding, right?
Yeah.
Great. So why is it a problem in an oligopolistic competition? It is a problem because it is assumed that in an oligopolistic competition, few large firms dominate. And if few large firms are dominating, it simply means those few large firms operate on a larger scale. And if they operate on a larger scale, that means the few left are, justly adjusted among the large numbers of smaller firms there. So if a new firm is setting up in an oligopolistic competition, it can't have the same power, the market power, those few large firms that are in existence has. As a result of that, whatever they produce is going to be few. So because they are producing fewer less, it means they will be incurring more cost compared to those large firms that are established in an oligopolistic competition. So one of the reasons why there might be barriers to entry is because of economies of scale. I think economies of scale is clear here.
Yeah.
There's economies of scale because the few large firms that dominate the industry produce on a larger scale. So if you are coming in as a small business, you still need to understand the nitty-gritty of the industry before you start producing on a larger scale. So in the course of when you put that into consideration, you wouldn't want to set up in that country or in that market. Do you get it on your place?
Yeah.
So that's barriers to entry. That's economies of scale. One of the reasons why we have barriers to entry. Yeah. Okay, yes. So the next one is patents. When you talk about patents, a patent is a legal document granting an inventor exclusive rights to their invention. So it simply means because you have invented this product, will give you a specific period of time for you to be able to recuperate the amount of money you have spent. That means you are able to recover the cost of invention. So mostly government does this, or mostly it happens in industries because they want to encourage firms to invest on research and development. That is why we have patents. And patents might be an hindrance to an oligopolistic competition. Is it clear?
Yeah.
Okay. So here I wrote, a patent is a legal document granting an inventor exclusive right to their invention, preventing others from making or using or selling it for a set period. It is a form of intellectual property. It allows firms which have invested in research and development to gain their huge cost of investment by charging a higher price for a period of time. So this means it might take a longer period of time before new firms set up in such markets. Is it clear, please? The third reasons why there could be barriers to entry or exit is branding. And when we talk about branding, we're talking about marketing and advertisements. So I wrote, the few large firms may be able to spend on advertising and marketing, which creates brand awareness and loyalty. Customers become emotionally attached to the product, and it becomes difficult for new firms to set up, produce, and gain customers. In an oligopolistic market, we have few large firms. And because there are few large firms, they operate on a larger scale. They exploit economies of scale. It means they have financial capability to invest or to finance advertisement and marketing. And if they're able to do that, that will bring about brand awareness for them. So for brand awareness, customers get attached to their brand. So a new firm coming in would struggle to keep up with those huge brands because customers are emotionally attached to the stronger brands. So it might be difficult for you to set up in. And that might even be the reason why you don't want to go into that market, because you can't compete. You feel you cannot compete with other big brands. Do you get it? Look at the market for cola. We have Coca-Cola, Pepsi, and there are other colas, right? But we barely know them.
Yeah.
So that kind of market, when you think about your own cola, you're like, will I be able to compete with Coca-Cola or Pepsi with their marketing strategy? So that might be the reason why you're not going to set up in that country, in that market. Clear?
Yeah.
That is for branding. Then the next one is sunk cost. For sunk cost, we're talking about costs that cannot be recovered if the firm chooses to leave the industry. So, yeah, I said we call it the exit cost. Look at the few large firms in that industry. Those few large firms would have invested heavily on infrastructure, facility, even employees and the rest. So if they suddenly want to leave the market because the market is not favorable, it becomes difficult. For example, let's take IKEA as an example. It has a lot of buildings. Do you think it would be easier for IKEA to leave the educational industry? Why? Because of the sunk cost. This cost will not be recovered. Do you understand sunk cost here?
Yeah.
Great. So, examples are investment in a failed marketing campaign. You've already paid, and the market it was not successful. You can't recover your money. Money spent on equipment that is no longer usable. Time spent on a project that is not producing the desired results. So all these things are sunk cost. You cannot recover them. So this is one of the reasons why it might be difficult for you to leave the market or come into the market when you put into consideration these things. So most of the time, firms, investors do not think about sunk cost whenever they want to set up, because sunk cost could stop you from setting up. I think it's clear.
Yeah.
Then the next one is legal barriers. For legal barriers, I wrote, the law may give firms particular privileges. The government may give a firm exclusive rights to the production of a product. So if government or the law gives you an exclusive right to make a product, so it means no one else can make such product. And that means you cannot come into that market to produce the same product. That's a barrier to entry. The last one we're going to talk about is limit pricing, which takes us to different behaviors in an oligopolistic competition. So when we talk about limit pricing, it is a strategy where a firm often a dominant one, set a lower price to stop or to discourage other firms from coming in. Despite the fact that they can as well set a higher price to gain more profit, but they will choose to set a limit price so that you get discouraged from coming into that industry. Do you understand? So that takes us to the last one, which is interdependence here. Right there?
Yeah.
For interdependence, I wrote in an oligopoly, there are few large firms, and actions of any one firm will have an impact on the other large firms in the market. So this simply means each firm will put into consideration other firms before making decisions. So this leads to the behavior of firms in an oligopolistic competition. So in an oligopolistic competition, because they have to make decisions, and in the course of making that decision, they have to put into consideration other firms. So that makes them to behave in different ways. So that will take us to what we call game theory, collusion, cartel.
What's cartel mean?
Cartel means group of people coming together to agree on price or to agree on supply. That's a cartel. So we'll talk about that in the next class. Okay.
Okay.